A new jobless claims report was higher than expected this week, showing even more signs of trouble for our economy.
Joining us to talk about it is Ted Rossman, Senior Industry Analyst with Bankrate. Ted, good to see you this afternoon.
Good to be here. Thank you.
All right. The first question, what do the latest job numbers tell us about the economy as a whole?
There's definitely been some weakening in the job market and in the overall economy. Q1 GDP came in slightly negative. As you mentioned, the weekly jobless claims a little bit more than expected. 241,000. The expectation was 225,000. We're kind of in the high normal range. I mean, generally speaking, if this number is between 200,000 and 250,000, it's not so bad. But people are on edge. People are worried about tariffs. They're worried about the markets. They're worried about just the state of everything. Friday's jobs report is going to be an interesting one because we've seen a lot of layoffs the first quarter of this year. We also saw surprisingly strong job creation in March. So the expectation for April is that job growth was more muted. It'll be interesting, though, where that number lands. The expectation is about 133,000. An upside surprise makes people breathe a little easier. A downside surprise, that's going to fuel some of the recession talk.
Yeah, there is so much uncertainty. What's interesting, though, is that much of the gain is from one state, New York.
A lot of the jobless claims were from New York. Now, that seems to have to do with a seasonal oddity, which is that public schools were on break. Support staff can claim unemployment during times like that. So we're talking about the kitchen staff, bus drivers, people like that. It seems that there was kind of some statistical noise leading New York to have an outsized impact in those weekly jobless claims.
Well, Ted, my co-anchor Andy's more positive of the two of this. I'll be the Debbie Downer question here with this next one. But do you expect things to get worse, or is there a glass half full aspect to any of this?
Right now, we're sort of stuck in between those two camps. I mean, on the tariff situation, things have been a bit brighter lately. A lot of the reciprocal tariffs were rolled back. Sort of seems like maybe the worst is avoided. Markets have rebounded. But people are still uneasy. We see that with consumer spending. We see that with jobs. We see it with all this recession talk. The economy had to slow to bring inflation down. We just don't want it to slow too much. And there's been kind of this fresh wave of uncertainty about tariffs, and businesses are kind of on hold right now, which impacts the job market because they're not investing a ton in people and products and infrastructure. So there's a lot of wait and see. It feels like we may know more in the weeks and months to come, although maybe new questions will emerge.
A lot of wait and see, and certainly fears of a recession. We want to ask you this again. We've asked you time and time again. Should families do anything different with their 401k or their investments?
Stay the course. That's important to have a long-term view. Over multi-year periods, the stock market does really well. We don't know where it's going to go any given day or week or month or even that year. But if we're talking 5 years, 10 years, longer horizons, your retirement fund affected by any of this, assuming that you're appropriately invested for your age and risk tolerance. But especially if you're in your 20s, your 30s, your 40s, you've got decades till retirement, don't make any big changes there. This is more short-term kind of noise.
We're all holding on. All right. Ted Rossman, Senior Industry Analyst for Bankrate. We appreciate your perspective and for joining us this afternoon. Thank you.
No problem. Thanks.